Hi everyone, welcome back to the third weekly market insights for the year. We are already 2 weeks into 2024. Our Singapore stocks market ended the second week of trading on a negative note last Friday. The benchmark STI index was down about 0.3% or 9 points to close at 3,191 points. Most of the Asia market in the region were in the red except for Japan and Malaysia, which rose 1.5% and 2.9% respectively. Shanghai Composite Index lost 0.16%, while Hong Kong Hang Seng Index was also down 0.35%. On the US side, the three major index ended last Friday a bit mixed. The Dow Jones Index was down 0.31%, while the S&P and 500 notched positive gains. The S&P 500 was up slightly at 0.08%, and the tech-heavy Nasdaq Composite Index managed to end Friday in the green, up 0.02%. On the weekly watch, US indices still remain steadfast and firm despite the inflation numbers coming in hotter than expected. Actual numbers of the US December CPI numbers came in at 3.4%, above analyst estimate of 3.2%. This is a sign that the inflation could flare up again or remain sticky for some time. The Dow Jones Index rose about 0.34% for the week to close at 37,592 points. Broad-based S&P 500 index also advanced 1.84% to settle at 4,783 points. Tech-heavy Nasdaq Composite jumped the highest for the week, up more than 3%, ending just below the 15,000 handle at 14,972 points. In Asia, Hong Kong stocks logged the second consecutive week of losses in the market worst start to the year since 2016. This is on speculation that China policy support so far will not be far enough to overcome the pessimism in the recovery of the outlook. The Hang Seng Index lost 1.8% last week to finish at 16,244 points after losing 3% in the first week of the year. The Hang Seng Tech Index also tumbled further by 3.39%. This was after the 4.57% drop last week, ending this week at 3,470 points. Consumer prices in China published last week fell 0.3% in December, the third straight month of decline, while producer price slumped about 2.7% per year after a 3% drop in November, reported by the Statistics Bureau in Beijing. Our STI index ended the second week of trading up 0.23% to 3,191 points after falling 1.73% in the first week of the year. If you would like to know more where the STI is heading from here, do check out our weekly market review show where I'll touch on the technicals of the STI index. Next, let's break down the performance of our benchmark index. The banking stock were a bit mixed for the week. DBS was the biggest loser among the three banks last week, losing 0.88% to close at $32.61. UOB slipped about 0.14% for the week to close at $28.30. OCBC bucked the trend of the other two banks, rising 0.55% to close at $12.88. SGX was also in the green, up by almost 2.17% to $9.89. SATS Limited, the flight caterer, led the index gainer last week with a massive 7.72% gain last week to close at $2.93. DFI Retail Group, on the other hand, was the biggest loser in our benchmark STI index, falling 3.95% to end the week at $2.19. So will the trend of this biggest gainer and biggest loser continue? Let's look at the technical analysis of the charts of both counters to see where it will be heading next week. First, let's look at SATS Limited, which provide in-flight catering and ground handling service for airlines. So SATS has been narrowing its losses in the past 2 years following the recovery in aviation and their consolidation with the Worldwide Flight Services Company. The company had a positive week last week, outperforming the STI index by more than 7% to close at $2.93. The stock 12-month high was seen on 2nd of February last year at $3.18, after which it pulled back to the year-to-date low at $2.37 on 14th of March. This stock generally has been trading in a range-bound direction for much of the second half of last year, between the range of $2.91 over here and the low of $2.41 towards the end of the year. Recently, last week, it retested this high of $2.91 and reached an intraday high of $2.94 last week. Both the shorter-term moving average 20 and 50 days in the white and yellow line were seen to be trending upwards since the beginning of the year. A golden cross also happened in the beginning of the year where the 50 days moving average in yellow crossed above the 200 days moving average in red, which was observed on the first trading day of the year. So a golden cross usually signals the beginning of a mid to long-term uptrend going to happen. The MACD indicator is also showing signs of very strong positive momentum in the prices as MACD line is diverging away from the signal lines and both are trajecting upwards. The RSI has also maintained above the 50-point neutral marks since the beginning of November last year, and the latest reading at 80 indicates that the price may be overbought right now and a pullback is highly possible. So with the golden cross signaling a mid to long-term uptrend that's going to happen, traders may use the shorter-term 20 days and 50 days moving average as possible level of support to ride the uptrend going upwards. And the next resistance that we could see for SATS share price could be the year-to-date high that we saw last year at $3.18. Next, let's look at DFI Retail Group. We covered this stock in the first weekly technical insights video for this year. The retail giant has a very positive month in November, as you can see over here, rising 12 to 13%. Indicators were also showing signs, but we were unable to break out of the long-term downtrend that we observed for much of last year after the strong performance in December. Prices have now broke below the 20 days and 50 days moving average at $2.24 and $2.26, which is the 20 days and 50 days moving average, eliminating any chances of a trend breakout soon and will most likely revert to the prevailing downtrend that we saw for much of last year. In this case, we do not see any support for the share price at least until we hit the year-to-date low again over here at the price of $2.11, which is the low of last year. Both the MACD indicator and the RSI indicator have also turned negative, breaching below their base level or their midline level. So with this reading, trader may use the 20 days and 50 days moving average as resistance level at $2.24 and $2.26 respectively for a short position riding the downtrend towards the year-to-date low last year at $2.11. And that's all I have for this week update. We do appreciate your support by giving us a like or a share and hit that subscribe button to stay up to date to our latest content. And I'll see you again next week in the next Technical Insights.